Good morning, ladies and gentlemen. I guess I can be heard.
Yes, good morning.
I hear you. Good morning.
Good morning. So it is 10:05 Ghana time, and I would like to appreciate you for making the time to join us. This morning, we are discussing corporate governance disclosures in financial statements or annual reports, as required for regulatory financial institutions. Additionally, we will touch on disclosures requirements for listed entities as required by the Securities Commission Ghana. This webinar is put together by Deloitte Ghana. We have with us the country managing partner, Daniel Owusu, who is ready to officially welcome us. My name is Dorapana. Daniel, your audience and remarks. Thank you.
Okay, good morning, everyone. Dora, I hope I can also be heard.
Yes, please.
Okay, thank you very much. And it's my pleasure to welcome you all to this webinar on corporate governance disclosures, Bank of Ghana and Securities and Exchange Commission requirements in financial statements. Invited guests, colleagues, and friends. As you know, corporate governance is fundamentally about balancing the interests of entities, stakeholders, which include shareholders, employees, management, customers, suppliers, financiers, as well as the wider trade landscape continues to evolve. The importance of transparent and effective corporate governance disclosures cannot be overestimated. These disclosures are not merely a matter of compliance. They are essentially for building trust, regarding the integrity and providing relevant tests to make the relevant and the informed decisions. Yet, we all know that meeting these requirements can be very complex for various reasons. Today, we have a unique opportunity to hear directly from regulators and from our internal industry experts who will share practical insights and best practice to help us navigate these challenges. It is all about getting our disclosures right. It is all about recognizing the significant value that robust governance and transparent disclosures bring to our stakeholders and to the organization as a whole. Whether you are a director, head of finance, company secretary, head of compliance, or finance professional, the knowledge and the perspective that will be shared on this valuable for strengthening your organization and reporting framework. Let me encourage you to stay engaged, ask questions, and make the most of this platform. Together, let's work towards raising the bar for corporate governance and financial reporting in Ghana. Thank you, and I wish you a productive session ahead. At this point, I will hand over to the next person, who is Ni Asafache Abe, who will take over and introduce the main panelists for today's session. Ni, if you can hear me, you can take over. Good morning.
Good morning. So thank you very much. Dora, would you want to come in before I do? Or when I'm done, I hand over to you?
Yes, just hand over to me when you are done.
If we could put up the presentation. So I will just give an overview of what it is we are going to discuss. As Mr. Osu said, corporate governance is important, especially in this modern economy where for many organizations or many corporations, there's a separation between ownership and control. So there have to be safeguards in place to protect the owners. And in the case of banks, their operations are largely with depositors' money. It is not theirs. And so there should be a means by which depositors and then regulators who are acting on behalf of all these other stakeholders, like Mr. Osu said, depositors in the case of banks, employees, the general public, there should be measures in place so that they can have confidence that the money that is being kept with them is safe. And so corporate governance is simply the means by which this is achieved. It's essentially a framework in which shareholders can own a business, managers operate the business, and then the board directors supervise the business on behalf of these shareholders and on behalf of all relevant stakeholders. And it's important because it forms a basis for the organization's approach to all other business activities. The governance framework allows the organization to oversee and manage various aspects, including things like enterprise risk and strategy, cybersecurity, environmental and social issues. And so if an organization, in this case, a bank, adheres to governance principles, it fosters trust amongst all the stakeholders because there's transparency, there's clear disclosure, there's a high level of accountability. So it doesn't leave room for doubt. We'll be looking at this a bit more as we go along. And even for private companies that don't have shareholders or they don't have a lot of regulators looking into their business, corporate governance is even very, very important too, because when corporate governance, good corporate governance is prioritized, it influences other key structures such as ownership, how succession is planned, risk is managed, recruitment, retention. It affects all those things. And having robust governance model also impacts even a private company's access to capital because lenders and investors, they are more confident in companies that have good corporate governance practices. Let's look at the benefits of having good corporate governance. If we could move on to the next slide. So as we've established, having good corporate governance allows a company to be transparent. And this helps it to establish accountability. When the company has the necessary rules, policies, and practices in place, it helps people calm down, and those who are stakeholders calm down. And even when there are problems and shareholders have to raise inquiries, those inquiries are not raised on fundamental things regarding the fiduciary duties of these governors, but rather they are aimed at the issues that led to the problem. It helps companies establish a commendable reputation, helping regulators, like I said, calm down, and so regulatory sanctions are reduced. Conflicts of, as stakeholders who are not part of the business, they are not aware of what other interests those charged with governance have in the organization. So sometimes they have concerns about whether their decision making is really independent and in the best interests of these shareholders. So having good corporate governance helps to confirm shareholders' authority. So even though they may have limited intervention, day-to-day intervention, it allows them, these are mechanisms that allow them to make sure that those charged with governance are fulfilling their fiduciary responsibilities and are prioritizing the shareholders' interests. And the advantages of good corporate governance extends beyond just the boardroom and how efficiently it runs. The value cascades to daily operations and even how relationships with shareholders are managed. So for instance, when we'll talk about disclosures shortly, if disclosures are managed well, it helps the board align its vision and approach to things with what the shareholders and other stakeholders also want. And a fundamental tenet of corporate governance is that all stakeholders are treated equally, or in this case, shareholders particularly, regardless of the size of their holdings. And so having good corporate governance allows this objective to be met. It makes sure that there's a high standard of integrity that the board and management have to adhere to. There's a code of conduct, there's absence of conflict of interest, and the board is able to demonstrate that they behave ethically and they are above board in all that they do. And if you look at the next slide, which is to talk about, could we move on to the next slide, please? The core principles mentioned there. We see concepts like integrity and transparency and honesty and fairness being shown. This is to show that for those who charge with governance, having a reputation for fair dealing, for not hiding things, for not just disclosing matters to the letter of what is required. You just disclose just enough to meet the requirements. No, your objective is to keep those who are supposed to be informed of the important things so they can make decisions appropriately, or if they choose to intervene, they can do so. If you are keeping to these principles, then you can say you are having a good corporate governance. And of course, it demonstrates that your responsibilities, you're handling them well. It demonstrates that you're really independent of the operations. And so you don't mix your objectives or your objectives don't conflict with that of the shareholders and other stakeholders. You're able to account for what you are supposed to do very well. Let's move on to the next slide. So here we look at disclosures. We've been mentioning it in this short discussion we've had. And this is where it's really important. In this case, we'll be looking at Bank of Ghana disclosures, SEC disclosures, and what the Companies Act. We've seen that it's listed here, informs stakeholders about how the company is managed and controlled. It promotes investor confidence, reduces risk, and so on. I like to compare disclosures in this context to managing, say, your boss at work or your parents. For those who, we've all been kids before. If you have that kind of relationship where you keep your boss informed of everything that is important, and your boss has that trust, or in this case, your parent has that trust that my son or my daughter will tell me anything that's important, even when there are problems. And in the case of running a business, sometimes bad financial results happen when it is not really anyone's, there's nothing really you can do. Probably the economy is in a free fall, and so what you can do internally is limited. When those things happen, there won't be serious questions raised about the competence or the integrity of those charged with governance, because they've created a track record of fair dealing, of clear reporting, of letting those who are supposed to know, those who have a right to certain information, they've declared all those things to them clearly. And so it helps to manage things when things don't go well. And it gives the stakeholders or shareholders, in this case, or regulators, the opportunity to intervene if they deem that it's appropriate to do so. That way, it's a collective effort to managing the organization as a whole. So as we said, the last point is that it promotes public confidence and trust, it promotes fairness, and then it boosts market integrity. So let's look at the disclosures required first by the Companies Act. So if we could move on to the slide on the Companies Act. So here, it's expected that there's clear disclosure on who the ultimate beneficial owner is. This helps even for the larger public. In my business as a forensic person, I often have to, when companies want to do mergers and acquisitions, or they want to work with a particular vendor or a particular supplier, they want to know who actually owns these companies so that they can check for things like conflict of interest and all this kind of stuff, and check against sanctions lists and so on. So if companies voluntarily disclose this information well, it serves the public interest. And of course, disclosing directors' emoluments, their pensions, how often they meet, and so on, shows to everyone that directors are devoting enough time to the interest of the company. They are not just treating as a side gig. but they take their work seriously, and so they are bringing their all to the game. They are really fulfilling their fiduciary responsibilities. Let's look at next the requirements from Bank of Ghana. So Bank of Ghana requires that disclosure about governance structure is done, the remuneration policy for both management and the board, the various board committees, the engagements, board evaluations that are done on a semi-annual basis. All those things are also disclosed. The conflict of interests are disclosed, that there's a statement on compliance with ethics and professionalism. Any related party transactions are also disclosed. Some of the big corporate failures in recent years in Ghana, even in the banking sector, they had to do with party transactions that were not disclosed in the case. So all these disclosures are important. The role that external auditors play, where we Deloitte often come in, that is also clearly stated. And any other disclosure requirements, BOG requires that these are displayed. SEC also has additional so SEC requires how many are independents, how many of them are executive directors, non-executive directors, all those things are disclosed. Are there appropriate committees in place, given the nature of the business, to run it well? Their duties are spelled out, the risk committee, what they are supposed to do, and the audit committee too. Sometimes these are put together, audit and risk committee. The nomination committee, remuneration committee, what they do is also important because the public wants to know, investors want to know the kind of payments being made to these directors and whether it dilutes their own stake in the company. So in short, these disclosures, they are just minimum requirements. It is for good corporate governance principles. It's usually advised, if you can, to go beyond this, because you want to demonstrate that you are above board in everything. So that, like we started at the beginning, you're able to build trust in your shareholders, in your regulators, as well as the general public, and in the case of banks, depositors. So I'd like to end here as an overview and then hand over to Dora for the panel discussion.
Very much, Lee. That is a detailed one, telling us what corporate governance is, how even on to the discussion, the regulators with us. And I will start to introduce Peter Aboji. Peter is an assistant director with Bank of Ghana. We also have with us Dr. Jacob. Dr. Jacob Edu is a director, corporate finance with Securities and Exchange Commission, Ghana. We have with us our internal industry expert, Charlotte Fossen Abbey. Charlotte is a financial services leader and audit partner with Deloitte Ghana. Gentlemen and lady, please join us with this conversation. Peter, I will start with you and I will pick your mind first before we go to the questions that we have.
Thank you very much, Dora.
Thank you.
And, good morning to everyone on the call. Mr. Osu, good morning. I just want to share a few thoughts before we zero in on the areas of the questions that you'll be asking. I think that we need to give a little background to and rationale for the corporate governance, aside what Nia has just told us. Between 2017, 2018, we all witnessed the banking sector cleanup. And as Nia indicated, one of the reasons why this happened was, from our perspective, lack of corporate governance structures being put in place. So this is what really necessitated the need for the central bank to come in, and then based on that, in 2018, we issued a corporate governance directive, and then followed it up with the disclosures. So the various benefits that NIE espoused will come to pass. It is extremely important for us also to know that it was in direct response to what we are seeing, and to ensure that one of the key stakeholders, that's the depositors, who eventually were one of the people that were very well hit in all of these things, would also have that mindset that indeed the regulator is doing something worthwhile to protect them going forward. So I just wanted us to have that as a background before we go into it. Thank you.
Good. That is very helpful. All right, so let me pick my first question with you, Peter. The directive required detailed disclosure of the governance structure in annual reports. What are the minimum expectations for such disclosures? And how does the Bank of Ghana assess their adequacy?
Okay, thank you very much, Dora. A central requirement of the Corporate Governance Directive is that the Board of Directors must annually certify the institution's performance and compliance with corporate governance. Now, in doing that, there are three key areas that are looked at. The first is that, are there any non-compliance issues involved? What was the period in which these issues came about? What are the remedial things that have been put in place to ensure that these things are solved? Going forward, what will be put in place? Now, these are things that we expect that we have a team of experts in the examination team within the Banking Supervision Department. Once they go out to the field for examination, they go and look at all of these things to see, take the board minutes. What were the non-compliance issues within the regulated financial institution? Do the board members understand their responsibility as people in charge of governance? This thing is also looked at, and all these things are reflected in the kinds of minutes that you see. I also want to mention is that the bank has put in place a requirement in the Corporate Governance Directive that the various board members must be certified. So within the year, they are enjoined to go to the National Banking College or any accredited institution from the Bank of Ghana to go and undertake some level of corporate governance training, awareness. And all of this goes to foster the kind of benefits that we talked about. So in terms of the governance structure, we expect that the size and composition of the board will be clearly stated in the audited financial statement. The total number of board meetings that have been held within the course of the year need to be stated in there. We also expect that the individual directors' attendance will be made known to us all in terms of what is put in the annual audited financial statements. Other directorships held by the directors would also be a part of the thing. So all of these things ensure that whoever takes the financial statements understands that there is a governance structure and there are people involved, and their role is to ensure that there's transparency. To give that level of confidence to whoever is reading the financial statement, whoever is the depositor, that indeed things are going on correctly within the regulated financial institution.
Thank you very much. So if I pick an annual report, I should be able to see the governance structure to help me take my decisions. Thank you. My next question to you, Peter, again, is what are the critical board committees that the regulatory financial institutions are expected to disclose? And what information about these committees should be included in the annual reports.
Thank you very much, Dora. So at the minimum, there are two key committees that every board of a regulated financial institution should have. And they are the audit committee and then the risk committee. For every board that we have brought into being in terms of giving them the go-ahead, they should have these two committees, the audit committee and the risk committee. Now, what is the audit committee all about? Their job is critically to ensure that they have oversight of the institution's internal and external audit function. We would ask ourselves, who is supposed to be on the audit committee? So the audit committee is chaired by a head who has to be an independent member of the board. So here I just need to put in context, within the boards of the various regulated financial institutions, the law requires that at least 30% of them should be independent. Now, out of that 30%, the chair should be an independent person of the audit committee. Then you can have the other members also serving on that. And now the disclosure is also that we should ensure that the terms of reference of the audit committee is clearly spelled out in the charter of the board. So what role they'll be playing has to be in there, and this has to be disclosed. Then also, they need to be competent in certain key areas, such as accounting, auditing, finance. It's something that will require, that would help them be the eye of the board. So as far as we are concerned, the audit committee is the eye of the board. And therefore, the eye sees everything that needs to be seen and then ensures that things go well. Now, based on all of these things, these disclosures are supposed to go in the financial statement. And then when our team gets on the field, as much as they submit returns to us, we now go onto the field, go to the banks in our examination, and then look at the various minutes of the audit committee. Are they performing the role that is expected of them? Are they disclosing issues? Are they interfacing with the chief internal auditor? So all these things are things that we expect to see that is disclosed to us. Then we also have the risk committee. The risk committee is also chaired by an experienced independent non-executive director. The role of the risk committee is such that they are to advise the board of the RFI on current and future risk and strategies for various identified risk areas. So the risk committee has a very, very important role to play. And they
Okay, I think we've lost Peter. So as we wait for Peter to complete the comments on the response to that the NDF report or the
that are external to the company and even debt holders. And so how are they assured that these companies are going to run well with the funds that they have provided? And so adequate returns could be made to them as a group of stakeholders who have provided funds for that enterprise. And so in our company's or code for corporate governance, we expect that every company will have an appropriate mix of persons with relevant skills and experience to man such businesses. We expect that I mean, you have not less than 5 members and not more than 13. And if these numbers are not adequate, you will have to explain why you think they are not. And so you have either gone below the 3 or gone above the 13. But whatever number of members that you have on your board, you must have majority of them being non-executive as opposed to the executive. And out of the non-executive, we also expect that majority of the non-executive will be independent. And one of the independent becomes the board chair. See, this composition is supposed to be a kind of a check on management where people who run the business all the time will not have the majority. And so whatever they bring, I mean, may not or might not receive critical external scrutiny. So this is the nature of the board composition that we have. And we are pleased to see, I mean, most of our listed companies are going by them. Those that are unable to meet some of the independent requirements, I mean, they come to the SEC, we give them time to try to restructure their boards to be in compliance with the requirements of the code. And the same requirement, this composition, as we have also explained here, actually is reported in the annual report of the companies every year. I think this particular one, and
Okay.
you can prove further, I mean, if you may.
Apologies for
welcome back.
Network misbehavior.
No problem. We are happy you're back. Okay, so let me pick my next question with you. Maybe you can get 1 second to close the other comment, but let me pick this one. In answering, you can get a minute to close the other question. So the directive mandates disclosures of board evaluation processes and outcomes. What constitutes a robust board evaluation, and how should results be communicated? How should the results be communicated in the annual reports? And how should the board evaluation be reported on or in the annual reports?
Okay, thank you very much, Dora. So I left off indicating that the role of the risk committee is key in that they oversee the senior management implementation of the risk strategy that has been set for the institution. And in doing that, they need to report exactly what has gone on. From the banking supervision point of view, they do that report to us quarterly, but then annually, it is expected that they put this in a financial statement for readers to know exactly what has gone on. One key directive disclosure that you have just referenced in terms of board evaluation. Now, the various boards are supposed to do their own self-internal assessment, and on a quarterly basis, inform BSD on what they are doing, how they are self-assessing the board in terms of individual members' contribution, the various committees that have been set on the board, and the tasks that have been assigned, and the deliveries and all that. Now, aside this, every 2 years, the directive is that they should have an external assessor. Now, there are 2 interesting things about this external assessment. Number one, it is to be done by an external body that has no conflict of interest or any dealings with the board. And they need to be approved by the central bank. So they would apply, and then the central bank grants them approval. And then every 2 years, the board is assessed. Now, in assessing the board, they are looking at the various committees have done, what the individual board members have also brought on board. The last time they did the evaluation, what were the issues that were raised? What have been done about those issues? Summary of key findings on the current evaluation. All these are supposed to be part of the disclosures that they will give or they'll bring on board in the financial statements. How the previous findings have been dealt with and all that. Now, all of these give a picture that even the board is being evaluated. So the board oversees the management, and then there's something that shows all of us that indeed the board is also being looked at. And so the central bank now also has interest in who assesses the board, and that's how robust it is. So the board cannot just appoint anybody or any firm just to come and do it. The application comes to the central bank. We also do our background check and then ensure that whoever they are bringing on board to evaluate the board itself, that firm also has what it takes, or that individual has what it takes to do the evaluation. That's how robust the process is. Thank you.
Thank you so much. So it is both internal assessments and external assessments. Thank you so much.
Exactly. And like I indicated, even the internal assessment, there's a report that they need to bring to the central bank for us to know how they have done that.
Thank you. Thank you. So my next question is also coming to you, Peter. The directive calls for this is about internal audit. So the directive calls for in the financial statement with regard to audit functions. What specific information should regulatory financial institutions include in their annual reports regarding the scope, independence, and effectiveness of internal audits?
So that is that the reporting structure of the internal audit function is key and should be disclosed. So the expectation is that the chief internal auditor should be independent, very, very independent, and report to the board audit committee. This is something that in the central bank we take very serious. And anytime we have any inkling that the chief internal auditor's independence is being threatened, we go in and go in hard. The reason being that, as I indicated, they are like the eye of the board. They are doing a job that they don't need to be, for lack of a better word, to fear anything. So they are supposed to do their job as independent as possible. They are supposed to show the adequacy of compliance of the various internal audits functions that have been performed. Now, one key thing that the audit committee has to do is to look at the internal audit work plan for the period, for the year, and then approve this. Now, all these things are things that we expect that they will be disclosed in the audited financial statement. The scope and then the nature of the audit work, how many times the audit has been carried out within the scope of the financial year. All these things are issues that we expect to be carried out. And currently, the internal audits, after they have done the audit, they submit returns and reports to the central bank and then indicate all the key findings, what has been done, what has not been done, what is outstanding. It is a requirement that we from them on every time there's an audit for every regulated financial institution.
Thank you very much. I think that is a unit that we have to pay attention to because of the importance to corporate governance. Dr. Edu, please, can you hear me?
Yes, I can hear you, please.
Good. So my next question is to you. So per the SEC's Code of Corporate Governance Disclosures, which board committees are mandated or recommended by the SEC's, by the SEC's Code, and what are their primary roles and responsibilities?
To run the affairs of the businesses. Of course, to run the affairs of the businesses. Of course, majority shareholders will make sure majority shareholders will make sure their investments are protected, and so they'll make sure that the code requires that one of the directors should take care of the interests of minority shareholders. And so where minority shareholders have issues, not only at AGMs, but whenever they pass their issues through the company secretary and to this board member, who is responsible for their matters. And in terms of board committees, the Code of Corporate Governance of the SEC mentions four board committees. It mentions the audit committee. Well, you can have other committees that you think you need that are not mentioned here. These are minimum requirements, and you may be able also to combine some of them so long as their activities do not conflict with one another, all for the interest of the organization. In terms of the audit committee, but most of the things that Mr. Jechi Abuaji has said, I mean, we share in them. If you read the two codes, there are substantial overlaps in there. But just to add that for the audit committee, they are responsible for overseeing the integrity of the accounting and reporting function of the enterprise. And so it is required that they have at least 3 members, and out of that 3, majority of them will be independent. But we also expect that the chairman of the audit committee is an accountant or professional accountant, not just an accountant, but a chartered accountant with recent experience in accounting, and so will be able to take care of all these matters. The audit committee also takes charge of the internal audit, engages with external auditors, makes sure the accounts are properly audited, and if there are issues, discussed with this committee before it, finally gets to the board. They are supposed to or expected to have reasonable knowledge of the business in which the business runs. I mean, if apart from the other, a few other issues that cannot be reported money-wise, most of the decisions of board members and management eventually crystallizes into monetary terms. And so if you don't understand the business that you are supposed to be a watchdog for, then how are you going to make sure everything has been captured well in terms of financial information and presented to the board and shareholders as a committee of that sort? The other committee that we also take care of is the nominations committee. See, the board members, have various tenures that they run. It's expected that not all of them should not retire at the same time, and so their tenures are staggered in such a way that at any point in time, there are some existing members that help with institutional memory and also continuity of activities on the board. And so the committee that must look for qualified people. In fact, including even advertising. And they have assembled a good number of people with relevant knowledge and experience in the business that the company, has or runs. The nominations committee then, presents its report on whoever they have got to be on the board to the entire board itself. The entire board looks at it. Those that will be approved will be done. And then at the shareholders meeting, these proposals on the members to be appointed will be made. And then the shareholders then passes, or the shareholders then pass the necessary resolutions to have board members appointed. And as we have said earlier, of ownership from control. People's eyes are on these companies. They make sure their investments are well protected. The regulators make sure that there is transparency, integrity, and that investors are protected. And so this is the approach the nominations committee is supposed to adopt and to run the company with. And of course, in the annual report, if there had been any such appointment within a period, it is also reported. I think the other committee is the risk management committee. Yes, it's also supposed to be made up of majority of independent board members. And in this world of massive uncertainty, one will wonder how a company will run without a risk committee that regularly looks at the business systems of the enterprise, its markets, fund. And if the company is not doing something well or something is going to go wrong, these things are early, observed and mitigation measures, taken to deal with them. So it's important that you have a committee that identifies risks, a committee that, after identifying them, tries to find solutions that will mitigate these risks, and then regularly meet and then also report to the main board to assure the board and the shareholders that the company will not collapse one day, or the company will not get up one day and find out that they had been overexposed to one supplier or a particular market. That market has ceased to exist, and so the company is no more. These are the things that they're supposed to do. Also, to have a business continuity plans where, the shareholders are assured, or the entire board is assured that should something fail, especially in their systems, the company will be able to continue to operate without any serious hitches. The remuneration committee is a mandatory committee that the SEC Code of Corporate Governance requires of companies that are listed on the stock exchange. They don't only determine remuneration for board members, but also they do it for senior management of the organization. And they are also supposed to report after they have paid them, whether in terms of normal salaries, allowances, because some of them are executive, and so they will take, salaries and allowances for the board members, even including pensions. Executives take pension, and if there are some also are rewarded in kind, some they have share options. All these things are made clear and approved at the board level, because the board has been given that power by the shareholders to determine the executive, director salaries and things like that. And so if these are done, then there's always the transparency. They know how much they are paying their directors, how much pension, whatever benefit that they are being given are transparent. And then also in the annual report, these figures are reported for the shareholders to know. And that is why if you attend some of these shareholders meetings, you see shareholders sometimes will say, you've given us such little amount of dividends, and look at how much is recorded as payments for directors. And without that transparency, how would the shareholder living somewhere whose shares is, I mean, very, 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 very minimal or small, be able to point out this? So ultimately, there is transparency in whatever the company does. The committees are also set up to make sure people with relevant skills and experiences take charge of different aspects of the company. And so the board as a whole, when they meet, I mean, they have the eyes of, I mean, their eyes then become the committee chairpersons who report to the board, so that holistically, the board will be able to know whether they are on the right path or they are not on the right path. So these are some of the issues that the committees are supposed to do. Of course, they also have terms of references that are given to them to help them do their work from the board. Thank you.
Thank you so much. So if we have picked annual reports of a listed entities, we should be seeing an audit committee, risk committee, nomination committee, minimum, right? Thank you. On conflict, Edu mentioned that during his presentation. So what are the key elements that the regulatory financial institutions must disclose regarding conflict of interest? Just a quick comment on that.
Thank you very much. Dora, can I be heard?
Yes, please.
Okay, thank you. This network keeps on. So at the minimum, when we talk about conflict of interest, one very fundamental thing that needs to be disclosed is the conflict of interest policy. That should as financial institution. So the policy has to be clearly defined for everyone to understand what they're talking about when they talk about conflict of interest. Then the duty of the director to avoid possible actions that may create conflict of interest is spelled out within the policy. Now, in the context of how should someone be conflicted, a board member be conflicted, how do they go about it? So the process by which you now have to disclose that, yes, for this particular activity or issue, I am conflicted. So the policy now also dictates how the director would now go about disclosing that indeed I am conflicted in a particular issue or not. And then the duty to disclose any matter that may result or has resulted in a conflict of interest. So if in the past something has happened and you had not disclosed it, the requirement is that you need to disclose it. Going forward also, if there's going to be any conflict of interest issue, you need to disclose it. And then we expect that you also abstain from any voting as will be prescribed by the Companies Act. Should you decide that there's something that conflicts you and they are voting, as a board member, you are not expected to vote. And then finally, the RFI is supposed to maintain an up-to-date record documenting and managing all the conflict of interest situations that arose within the period be disclosed for all to know that indeed this is what happened. Thank you.
You are welcome. So does that mean during your examination, you check the conflict of interest register?
So during our examination, what I need to mention is that we have corporate governance toolkits that once we developed these directives and these disclosures, we took the industry through and we even gave them to the RFIs to be a guide. So when we get onto the field, it's like a template. There are things that we look out for. So we go through them one by one, and then we look at this register to see whether indeed in the course of the year, look at it. How was it treated? How was it disclosed? So we look at all of these things once we get onto the field.
Thank you very, very much. So in terms of related parties, this is one of the key areas that we have. How does the directive address the disclosures of related party transactions? And what level of detail is expected in annual reports? 1 minute response will be very much helpful.
Okay, so the disclosure of related party, the various key elements are just to include intra-group activities. So if within the group, you have things that you have done, we expect that you disclose the statement. And then also we ensure that it is not preferential. So if you have dealt with each other, yes, don't, because you are related, it should not be softer than what you would have done if you were dealing with any other party. So all these related party disclosures are expected to be brought to bear by the RFI when they prepare their financial statements. Just brief on that.
Thank you very, very much. Let me just mention that, audience, please, you can be putting your questions together. We will have a session for Q&A. Dr. Edu,
Yeah,
please. From SEC perspective, what are the specific disclosures required under annual reports?
Thank you very much, Madam Dora. We have a host of them. There is a section in our code, section 24, that outlines a number of issues that the annual report of a listed company, must disclose. I think the very first is that the board must take responsibility for every information that is disclosed in the annual report. And so the board members, or two of them, sign to the effect that whatever information that is disclosed in the annual report, they are responsible for it, and no other person. I mentioned earlier, the board also supposed to disclose in the annual report the board membership structure, composition. They are supposed to have, of course, the financial statements audited, also all in the annual report to be disclosed. They have to disclose also the list of, significant shareholders. Normally they do it like 20 top or so. Just to, let everybody know that if there is any persons in trying to gain control, is able to see. Otherwise, one day you are there and, of course, the security is listed and nobody is barred from buying. If there are shares available for buying and somebody is gradually approaching the takeover level and you don't try to deal with it, and one day you trigger the SEC takeover rules, then you wouldn't have to come and complain that the SEC is assisting some people to come and take over your company. One of the things that they must do is to make sure the shareholding structure is monitored and reported on in the annual report. There are a few other things that they are supposed to disclose, including the fact that if there are any material risks that the company envisages might affect in the ensuing year, the year to come, then they must try to disclose, and so we will know how to deal with such matters. You will find in our report every committee report of the company and many other issues. These all help to provide the shareholders and even potential shareholders. In fact, there is this aspect which is very important. They are supposed to also ensure that there is adequate discussions on the operations of the company, the section that we call management discussions and analysis, where the performance of the company is discussed and where, future, at least, prospects for the fully also discussed. If there are any matters of, concern, these are all discussed to get the shareholders well informed. And these are what enable the shareholders to determine whether they will continue to hold shares in the company, whether they want to sell or whether they want to even buy more. So it's very essential that the annual report is done and published in line with the Companies Act. Of course, well, actually, whatever we do here is in addition to what the Companies Code requires. There has not been an occasion where you found that, there's something in our code, that conflicts with the Companies Act. No, the Companies Code is minimum. Ours, even though it's an additional, is also minimum. And companies are supposed to do work well and report transparently every relevant information that they think shareholders will need to be able to take, informed investment decisions. So I think I'll pause here and wait for any further questions. Thank you, Madam.
Thank you very much. Every relevant information should be disclosed in the financial statement. Thank you. Charlotte, so with governance, it's all about. We've heard from the regulators as well, telling us how they should be disclosed. Charlotte, what are the roles of external auditors in relation to corporate governance disclosures in financial statements?
Hi, Dora. Please, let me know if you can hear me.
Yes, we can hear you.
Okay, thank you very much, and good morning again to my fellow panel members and to everyone on this webinar. So yes, the auditors is we are in the hot seat now. Yeah, so there are roles that auditors are expected, external auditors, I should say, are expected to play in the grand scheme of things. So, for instance, I can talk about things like auditors verifying that these RFIs and then the listed companies, the institutions, let me put it in general, they are complying with the disclosure. So one of the things to look out for is to ensure that whatever disclosures are in the financial statement, the reports, they meet the legal and regulatory requirements. So verification of compliance by the entities is one of the things that we do as auditors. Another thing is that we ensure that the accuracy, the completeness, and clarity of disclosures is assessed. Why do we do that? We want to ensure that whatever has been given is accurate. So it's not just about disclosing anything at all, but the information that is given in the report, it must be accurate. So we check where numbers are involved, where narratives are involved. We go through to ensure that they are in line with what is required by the regulators and by legally as well. Another thing is that we also test and evaluate the controls. So when you are reviewing these corporate governance structures, the structures that are in place, you want to ensure that there are internal controls that make sure that they are effective, they are applied, they are applicable throughout the year and all that. So, for example, one of the things we do as auditors is to look at entity level controls or controls at the overall, generally, the business as well. And at that point, we expect that, for instance, the board must be in place, they must set the tone at the top, they are complying with their own policies and procedures, and it trickles down to the common cleaner in the organization. So we test the controls and evaluate them to see that they are working effectively. We can also look at reporting to the governance body. So, for example, we communicate our findings to the board members, to the audit committee, even to the regulators, because, for instance, when we do the bank audit, you know that one of the requirements is that Our management letter is filed with Bank of Ghana in addition to the financial statement and the long form. Actually, the reporting is done. The findings are also communicated to them. I can also talk about enhancing stakeholder confidence. So we actually provide that independent assurance to stakeholders. So we are coming from the outside. We are not within the organization. That's why it's important that we are independent as auditors to the entities that we are auditing. And then when we give that third eye view, then stakeholders they have the confidence that, okay, the business is doing well, the structures are working, everyone is playing their role as expected. Sorry. Another thing that we also look out for in terms of looking at these corporate governance structures is identifying and reporting issues. I think I've mentioned that, but in this case, that where there are material misstatements or where there's non-compliance, it is communicated accordingly. And then another thing is that we have best practices applied. So you see that in the management letter point, and then the issues that we identify, we speak about what best practice is, so that the board and management can also see that, look, something is being done better elsewhere, and that is the best practice. Why don't we apply it in our space? I can make reference to one of the requirements in the by the regulator, by Bank of Ghana, for example. So in the Bank of Ghana Corporate Governance Disclosure Directive, I'll just quote this part, which says that external auditors should review and make comments on the corporate governance practices and corporate governance reports of the regulated financial institutions in the other matters section of the independent auditors report. So you see that in the auditors report, there's an other matters section, and this is where we speak about compliance with all of these requirements. The external auditors must also be independent and must be appropriately qualified to act with due care. So you see that that's the very last bit of the auditors report where we sign off. So you have to state that you are independent. If you are not independent, it will be known. It's difficult to hide. So yes, in summary, auditors are supposed to act as independent reviewers who help to ensure that the corporate governance disclosures in the financial statements, they are accurate, they are complete, they are compliant with the relevant standards, and thus we support transparency and stakeholder trust. Dora, actually go on.
No, it is fine now. I'm taking it that you are saying that it is a shared responsibility. Is that correct?
By all means.
Good.
Shared responsibility. It's not just only the board and management. We also have our role to play. But then I think I must be quick to add that even though everybody has its own defined role and responsibility. So yes, we can talk about the fact that regulators are saying that we should do this. The corporate governance works of the entity is also supposed to play their role, and we are something that we have to do, but we don't do the same thing. Okay, nature and extent of the responsibilities, they are distinct and complementary. We have our things. So let me just mention even on that. For example, when you talk about the directors or the board of the organization, they prepare the disclosures. I'm not saying that they are the ones who say, but they set the structures in place. So there's the person in management, the people there, and they ensure that all their policies and procedures are working effectively. So they are responsible for preparing these disclosures and also ensuring compliance with what is required by the regulators. Now, as external auditors, what do? Our responsibility is to ensure that the disclosures are there, they are accurate. Another thing is, as I mentioned earlier, is to ensure that we report any misstatements or inconsistencies based on what the standards require. And then we also provide that independent assurance. So yes, it's a shared responsibility in that both directors and external auditors, we play very important roles in the process, but our duties are different, and we should ensure that each group is playing their role as is expected. That is what will actually make us bring out any conflict of interest. That will ensure that we are being transparent, and then the reports actually speak about what is happening in the organization. Yeah.
This is very, very clear.
And Dora, if
So,
I may add just a little bit to what Madam Charlotte indicated. So currently what we see is that you might not see it in the other matters section as we originally indicated, because per the various requests by the auditing standards that came to our notice, we gave a new section. So it's you report it on the other legal and regulatory requirements section, which is almost the same. It's just a change of terminology for us. So just for members to just put it in context. And then I also need to indicate that the act itself that we operate to the Act 930, Section 85 also now lends credence to what we expect of the external auditor in terms of reporting some of these issues on corporate governance, compliance, all the relevant issues. And it's something that we look out for anytime the financials are released.
thank you very much. So audience, please, you can start your questions. I take questions now. We have one question for. So, what are the implications if a particular group of shareholders of a financial institution nominate a board member from their group while also taking loans from the bank? So, I think, Peter, this will be for you.
Yes, so this is clearly, can I be heard, please?
Yes, please.
Okay, so this is clearly a case of a related party. And so all the disclosures that we require of a related party should be done. Now, first and foremost, if
Hello, Peter.
Network.
Yes, yes. Dr. Edu, can you,
Yes.
I'm sure it's the same.
Please, if you can repeat the question, am I muted?
Okay. So what are the implications if a particular group shareholders of a financial institution nominate a board member from their group whilst also taking loans from the bank?
Can I be heard?
Oh, okay, you're back.
He's back. Okay, right. Thank you.
Yes, you can be heard.
Okay, I'm sorry. This network is just something else. But I was indicated that we have a fit and proper persons directive that we have issued. So anybody that sits on a board for any regulated financial institution. Now, when they are one of them is financial integrity. So if anybody goes to take any loan from any institution and does not pay, and he's nominated to sit on a board, the first thing that we do is that we use that as a basis. You need to make good your debt before you come and sit on a particular board, because financially you don't have that integrity. Then we look at the conflict of interest. We look at your time commitment. We look at your academic qualification, your experience. These are minimum assessment criteria that we look at before whoever it is comes to sit on the board. Now, for a shareholder, the fact that in quotes you have the money does not automatically make you being capable of being a good shareholder. So once the application is made, there are things that the central bank also, or banking supervision, would take the application through. And one of them is financial integrity. Where is the source of the money coming from? That verification needs to be done before it is accepted. We look at the reputation of the shareholder. Out there, what are you known for? Within the business circles, within the banking circles, what are you known for? Have you demonstrated sufficient appreciation of banking business? So just to put it in, have money does not necessarily mean once you walk into the shores of the central bank that you want to open a bank, would open our arms and say, yes, come in. There are checks that we do to ensure that eventually, once you open a bank, it is the depositors' funds that you use to trade, or that the depositor is protected from any shareholder who has come in with any other motive other than doing the business of banking.
Thank you very, very much. We have about 3 minutes to go. We have a lot of questions. If we are not able to respond to your question here, please, we will revert to you with your response. So let me pick this one. I think we can handle one. For financial institutions, can the audit and risk committee be combined, or do they need to be separated?
So one is second line, the other is third line, first line. So they cannot be put together. So the disclosure requirements are specific. That is why when I was giving the speech on that, I said at the minimum, there should be an audit committee and a risk committee. They are separate. In fact, the chairperson for the audit committee cannot be the chairperson for the risk committee. You have to be independent, and the roles are separately done and performed. So no, they cannot be put together as one committee, irrespective of the size of the board. We would encourage that at one line of defense, and then internal audit will be the third line commingled at any point.
Thank you very much. Dr. Edu, let me pose this one to you. So does SEC have any rules to limit unequal access to information among shareholders in institutions with group relationship through corporate governance?
Yes. In the corporate governance rules, companies are supposed to have what we call investor relation, and somebody assigned to attend to shareholders' issues. And so if a member of the public or shareholder encounters any problem trying to obtain whatever explanation from a company, you can file a complaint with the SEC, and that company will be invited to explain why, that behavior was put up. So there are rules in respect of that. Thank you.
Thank you very much. Charlotte, how does external audit provide some level of assurance for governance factors like integrity?
Thanks, Dora. So as part of our work, we say that when we go into any organization, we want to understand the business better, for example. So we take this documentation process very, very serious. Now, in trying to understand the business of any institution, I think that one of the things we look out for, the related party part has already even been spoken about, where we ensure that they are disclosed, there's no information that is hidden. Now, before we even go into an organization to start our audit, or right at the beginning, we do things like looking at the board members and key management personnel. Okay, maybe we cannot interview or look for the background of everybody, but at least the board members, key management personnel, we do our own background checks. We use various search engines, and we also look at what is in the media, what we can even get from the ordinary internet to probe to find out whether even the people who are serving on the board, there are no issues, okay, before they came on board. Now, we also do things like doing the fraud discussion, the interviews, where we will speak to those charged with governance, we will speak to key management. We can even pick an ordinary person in the organization as part of our process to find out whether processes are working or not. So we look at all of these things You cannot, I mean, there's no one formula, but all this information gathering, all these interviews, all these discussions, they are supposed to help us auditors to, if there are any issues on integrity, whether at the organization level, whether at individual membership, maybe it has came out of Ghana when they were confirming that appointment. So we check all of these things to ensure that at least the people who are managing the business, they have integrity. If there's anything we identify in the course of doing all of this, we actually point it out, we report it, as we said, it's part of our roles and responsibilities in ensuring that the corporate governance structures are working. So yeah, there's a lot of work that goes into this, but it's important that they are also done, because in doing all of these interviews, the discussions, documentation, it opens your mind to a lot of things. You come across things that probably you may not have seen written anywhere. And then, of course, as auditors, we are supposed to be skeptical. Professional skepticism is an important part of what we do. So things will not be spelled out in black and white, but as you go about doing your reading, your research, and the interviews, and even testing the balances, your antenna, your skepticism antenna should be high up there. Something you pick and then you follow up on could open a box of or a can of worms that will lead to other things. So these are all things that we do. And then, of course, we also, disclose the interest of directors, things that you look at the interest register, you check to see whether anything is there. You look out for the conflict of interest, as has already been mentioned, and all of that. So we do varied things to ensure that we achieve that particular goal.
Our time is far gone. So I think this is what the time can allow. We have a lot of questions. As I said earlier, we will respond to each one of them. Thank you. I had wanted to ask for a closing remark from our regulators, but the time is far gone. So thank you so much, Dr. Jacob Edu. Thank you, Peter. Charlotte, thank you. Charlotte, can you just close the session for a minute?
Okay, Dora. Thank you very much. So, distinguished ladies and gentlemen, thank you so much for joining us this morning. We are
audit season, long hours, lots of requests. Imagine intelligent digital assistants working alongside our teams, streamlining processes and reducing disruption. It's the future of professional services, powered by intelligent multi-agent systems in our global platform, Deloitte Omnia. Specialized agents work behind the scenes, supporting our people throughout the audit. Our evidence-gathering agents automatically retrieve requests in our client collaboration system, Deloitte Connect, enabling real-time reviews and populating Omnia with the necessary information within minutes. Our professionals oversee the work of the agents, verifying that it is completed with high quality and accuracy. This isn't about replacing people. It's about empowering them with the latest technology to deliver their uniquely human knowledge and insight. Smarter audits, tailored assurance, powered by technology, delivered by professionals.
Thank you once again for joining us. Stay and let's keep raising the bar for corporate governance.
An IPO window can close fast. So, if you want to ring the bell on Wall Street, raise additional capital, launch new products, and land your company on the covers of magazines, be ready when the window opens. With financial rigor, operational controls, corporate governance, and transparency that builds investor confidence. Do that, and what lies ahead can be as clear as, well, your IPO window. Audit and IPO readiness services from Deloitte. Look again.
The future is change. It's disruption. It's coming faster than you might think. New technologies like artificial intelligence, machine learning, and cloud computing are transforming the way businesses operate. The audit of today is not the audit of tomorrow. That's why it's time to reimagine the audit. And who better to do it than us? It's our legacy. After all, Deloitte has been doing this for almost 175 years. Our founder was an innovator in the public accounting profession. Now, it's our time to innovate. This is not change as usual. This is about transforming to meet the challenges in this new era. It isn't going to be easy, and it isn't going to happen overnight. It's going to take a commitment to new ways of thinking and working. And most importantly, it's going to take us, all of us, working together to get it done. Because while we can't predict our future, we can create it.